You paid every bill on time. You didn't miss a single due date. You didn't apply for anything new, and your credit score still dropped. If that has happened to you, you are not imagining it, and you did not secretly do something wrong. The average FICO score in America just fell to 714, and 14% of Gen Z borrowers saw drops of 50 points or more in the past year alone. That is double the rate from just a few years ago. Here is the part almost nobody explains clearly. Payment history is only 35% of your score. The other 65% can move against you even when your behavior is completely spotless. Sometimes it happens because of a single day's timing. Sometimes it happens because of something that isn't even your own account. Today I am breaking down exactly why this happens. I will walk you through the 5 specific triggers most people never see coming, and I will show you what to actually check the moment your score drops for no obvious reason. Let's get into it. Most people are working from a mental model that is incomplete. The idea is simple. Pay on time, and the score takes care of itself. That is true for 35% of the formula. The rest is built from 4 other categories that have nothing to do with whether you paid your bill. According to FICO's published methodology, the score breaks down into 5 parts. Payment history is 35%. Amounts owed and credit utilization together make up 30%. Length of credit history is 15%. New credit is 10%. And credit mix is the final 10%. That means 65% of your score is being shaped by things that can shift even during a month when you did everything right. And right now, that gap is catching more people than usual. Credit card delinquency rates nationally have reached levels not seen since the aftermath of the 2008 financial crisis. That means the entire scoring system is more sensitive to small changes than it has been in over a decade. Let's start with the first trigger. This is the single most common cause of an unexplained score drop. And it has nothing to do with spending more money than usual. Here is the mechanism. Your credit card issuer reports your balance to the bureaus on your statement closing date. It does not report it on the date you actually pay it off. Imagine you charge $5,500 in travel expenses 2 days before your statement closes. Then you pay the entire balance in full a week later. The bureaus still saw that high balance on the day the statement closed. Your utilization ratio is how much of your available credit you are using. That ratio is calculated from that snapshot, not from your final fully paid balance. Utilization is the second largest factor in your score at 30%, and it is the single most common cause of a real, noticeable point swing. Most scoring models want your utilization under 30%, but scores are meaningfully more resilient when you stay under 10%. If a big purchase lands right before your statement closes, your reported utilization can spike. This can happen even though your actual financial behavior was completely responsible. The fix is not to stop making necessary purchases. The fix is understanding how timing works relative to your statement date. You can make a payment before the statement closes rather than after. That simple move can prevent the snapshot from ever looking inflated. Now let's talk about the second trigger. This one catches financially responsible people specifically. Closing an old, unused card feels like a smart, tidy decision. But it can quietly work against you. If that card carried a meaningful credit limit, closing it reduces your total available credit. Even if your actual spending stays exactly the same, your utilization ratio rises overnight. That is because the same balance is now being measured against a smaller total limit. The account's age also stops counting toward your length of credit history over time. And remember, length of credit history is 15% of your score on its own. Opening a new card has a similar but different effect. A hard inquiry causes a small temporary dip, and it slightly lowers the average age of your accounts. Neither of these actions is a mistake, but both explain a drop that has absolutely nothing to do with a missed payment. That is exactly why they catch people off guard. Now here is the third trigger, and it feels the most unfair. This one can genuinely happen without you doing anything at all. Your utilization ratio is calculated across your total available credit. That means it is not just about the one card you are actively using. Say a different issuer lowers the credit limit on a card you rarely touch, or say they close a dormant account for inactivity. Your total available credit shrinks, and your overall utilization rises, even though your spending never changed on any card. Issuers have been doing this more frequently as delinquency rates climb nationally. They are reducing exposure on accounts they see as higher risk, and they do this regardless of your individual payment history on that specific card. This is exactly why checking your full credit report matters, not just your score. After an unexplained drop, look at the details. The change usually isn't hidden. It is just sitting on an account you weren't actively watching. Now let's move to the fourth trigger, and this one is genuinely new. Most credit education content hasn't caught up to it yet. Buy now, pay later. loans are increasingly being reported to credit bureaus in 2026. That means a payment history that used to stay completely invisible to your score can now affect it. This includes a late payment on a BNPL installment that is only a fraction of a typical credit card payment. Student loan delinquencies have also returned in force following the end of pandemic-era pauses. Federal collections activity has resumed, and that has pushed more than 1 in 5 federal student loan borrowers with a payment due into serious delinquency territory. Medical debt reporting is also shifting. After several years of increased consumer protections limiting it, it has started showing back up on some reports as those protections narrow. None of these 3 changes are about your day-to-day spending behavior at all. They are structural changes to what is being measured, and they are all arriving at the same time. That is part of why unexplained drops feel more common in 2026 than they did even 2 or 3 years ago. So let's step back and ask why this really matters. If you are not actively applying for anything, a modest, unexplained drop is genuinely not urgent. Scores fluctuate constantly. A small dip from a timing issue typically self-corrects within 1 to 2 billing cycles once the reporting catches up to reality. But if you are inside a mortgage application window, the math changes completely. The median credit score for new mortgage origination sits at 775. A drop from 775 to 715 is well within the range some of these triggers alone can cause. That kind of drop can mean a higher interest rate. Often it is 1/4 to 1/2 percentage point on a conventional loan. It can also mean higher mortgage insurance premiums if your down payment is under 20%, and it can mean possible loss of access to the best conventional loan programs entirely. If you are inside an active loan file, lenders will tell you directly, don't take on new revolving balances, and don't close old accounts until after closing. The stakes of these small triggers scale enormously depending on what you are about to do with your score. So let's turn all of this into a clear action plan for the moment a drop appears. Step 1. Pull your full credit report, not just the score number your app shows you. Look at every account, including the ones you rarely use. Step 2. Check whether a limit was reduced or an account was closed on a card you weren't watching. Step 3. Look at the timing of your last statement closing dates against any large purchases you made. Step 4. Check for any new BNPL, student loan, or medical debt entries that recently started reporting. Step 5. Confirm there are no accounts or inquiries you don't recognize, which could signal a reporting error or fraud. Once you know the cause, you know the response. If it is a timing issue, pay before your statement closes next month and watch it recover. If it is a limit reduction, avoid closing more accounts and let your utilization normalize. If it is a new reporting entry, verify it is accurate and dispute anything that is wrong. A dropped credit score, even with a perfect payment record, usually isn't a mystery. And it usually isn't a mistake on your part. It is the system reacting to timing, to available credit, and to new rules about what gets measured. Once you understand these 5 triggers, an unexplained drop stops feeling random. You know where to look, and you know exactly what to do next.